I want you to imagine something with me for a second. Just picture this. You wake up on a random Tuesday morning.
Okay.
The sun is shining. And you reach over to your nightstand, grab your phone, and open up your portfolio app, just out of habit.
Like we all do, right? The morning routine.
Exactly, the morning routine. But suddenly, your eyes just go wide.
Yeah.
A position you took maybe just a few months ago, it has completely tripled.
Oh, wow.
Yeah. Your heart starts racing, and before you even, get out of bed, your brain is doing that rapid-fire mental math.
Calculating everything.
Right, calculating what you could buy, how your entire financial trajectory might have just, shifted forever. It's an intoxicating feeling.
It really is.
Yeah.
I mean, it is the ultimate modern financial fantasy. It operates on this dopamine loop that traditional markets simply cannot match.
But hold that thought,
Huh.
because I want you to imagine the exact opposite scenario. Same Tuesday morning, same routine.
Right.
You wake up, you check your app, and half your net worth is gone.
Just gone.
Wiped out. In a matter of hours while you were sleeping. And there's no warning. There's no circuit breaker that halted trading to let the market cool off.
No guardrails.
Exactly. There is no customer service hotline to call and ask what went wrong. The capital is simply vanished.
And that whiplash, I mean, that is the reality of crypto. It's a space where those two extreme scenarios exist simultaneously, separated by nothing more than, a few lines of code and human psychology.
And that is exactly what we're dissecting today. We're pulling from an incredibly insightful piece of writing titled The Bitcoin Gamble: Wealth, Risk, and the Discipline of Crypto.
You're a great piece.
It really is. And our mission for this deep dive is to look strictly at the hidden psychological traps, the brutal structural realities of decentralized liquidity, and the precise discipline required to survive.
Yeah, the actual survival mechanism.
Right. And because we know you already follow this space, we were entirely skipping the 101 level definitions. You already know what a blockchain is. Today is about the actual mechanics of the market. Okay, let's unpack this.
We really have to start by looking at how this asset class evolved.
Yeah.
Because the source material, it maps out a transition that fundamentally changed investor behavior.
How so?
Well, if you look back at the early days, Bitcoin was largely ignored by traditional finance. I mean, it was viewed as an eccentric internet experiment, a playground for cryptographers.
It definitely wasn't seen as a wealth generation tool. People thought it was, a scam or maybe a novelty worth fractions of a penny.
Exactly. But as the market capitalization grew and prices hit mainstream consciousness, the narrative shifted entirely. The asset stopped being a mere technological experiment and transformed into a highly efficient emotion-generating machine.
It's an emotion machine.
Yeah. And the primary emotion it began to manufacture at scale was hope.
Let's talk about how that hope is actually manufactured, because the text points out a stark contrast that drives the entire market cycle. We see this constant stream of viral success stories, right?
Oh, everywhere.
You log on to social media, and you see the ordinary person who threw, a few $100s into a random meme coin and is suddenly buying a mansion.
Right. The algorithm just pushes those stories to the top of your feed because they drive engagement.
Exactly. But the devastating losses, those stay completely quiet. I mean, nobody posts a TikTok about losing their kid's college fund on an over-leveraged long position.
No, they definitely don't. And what's fascinating here is how that severe imbalance in information directly warps the risk assessment of a new investor.
It skews everything.
It really does, because when your feed is saturated with anomalous, life-changing wealth, it artificially distorts your perception of probability. It creates survivorship bias on an unprecedented scale.
It reminds me of walking into a massive, glamorous casino. But the mechanics of this casino were very specific.
Okay, how so?
Well, every single time someone hits a jackpot, the management announces it over a stadium-grade megaphone. Lights flash, sirens go off.
Making a huge spectacle of it.
Exactly. But what the megaphone deliberately drowns out is the silent reality of thousands of other people sitting at the tables, quietly and agonizingly emptying their bank accounts. The loud winners create an illusion that winning is the default state of the building.
That is a perfect analogy. And in the crypto market, those silent losers are essentially funding the jackpot winners.
Right.
It is a closed system of capital transfer. But because the beginner only hears the megaphone, they are pulled into a game they don't actually understand.
Yeah, they aren't buying into an asset because they have a thesis on decentralized settlement, right?
No, they are buying a lottery ticket out of a desperate feeling of being left behind. FOMO, essentially.
They enter blindly, fueled entirely by that manufactured hope you mentioned. So what happens when the inevitable contraction occurs? Because, I mean, even if the broader macro trend is up, this market always eventually crashes.
It always does. And when it does, the manufactured hope evaporates in an instant. And because it wasn't backed by any fundamental understanding, it is immediately replaced by sheer terror. Yeah, terror. They have no psychological armor. Their immediate visceral reaction is just to sell everything at a massive loss just to make the psychological pain stop.
Okay, but I have to stop you there.
Yep.
Survivorship bias and manufactured hope, they pull impatient people in, absolutely.
Sure.
But impatient people exist in the stock market, too. I mean, retail investors chase trends in traditional equities all the time, and yet blue chip stocks rarely drop 50% over a long weekend.
That's very true.
So the psychology alone can't fully explain the whiplash, what is happening under the hood of the asset itself.
That is the critical pivot. To understand the volatility, we have to move past the psychology and look at the structural architecture of a decentralized market.
Okay.
The text emphasizes that Bitcoin and broader cryptocurrencies operate without central banks, without traditional corporate earnings, and without centralized market makers.
So what does this all mean? I have to push back on the hype a little bit here,
Right.
because the crypto community constantly champions this lack of central authority as the ultimate financial freedom.
They do, yeah.
They celebrate the removal of the middleman. But if I'm an investor and you tell me that this market lacks all their traditional structural buffers, I mean, there is no central bank to step in and provide liquidity during a crisis, no regulatory body to halt trading if a panic cascade staves. Isn't that zero guardrail environment inherently terrifying? Why is that celebrated?
This raises an important question. Is financial freedom actually a benefit if you do not understand the mechanics of operating without a safety net?
Right, exactly.
The celebration of decentralization often ignores the mathematical reality of unsmoothed markets. In traditional finance, you have massive institutions acting as market makers.
Okay.
And they are legally or structurally obligated to provide liquidity, meaning they keep buy and sell orders relatively tight even during a panic.
They act as shock absorbers.
Yes. But in crypto, the liquidity is heavily fragmented and often heavily reliant on retail and algorithmic trading.
So it's much thinner.
Much thinner. When panic sets in, buyers pull their bids. They cancel their orders to buy at the current price and move them drastically lower, just waiting to catch the bottom.
So the order book just hollows out.
The order book completely thins out. So when a terrified retail investor hits market sell to get out at any cost, their sell order drops through empty air.
Wow.
It keeps dropping and dropping until it finally hits one of those ridiculously low bids. That thin liquidity is mathematically why a price can plummet 20% in an hour.
And it gets worse when you add leverage into the mix, right?
Yeah,
Because people aren't just selling what they own, they are being forcefully liquidated.
absolutely. Leverage is basically the gasoline on the fire of a thin order book. Traders borrow money against their holdings to increase their position size.
Right.
When that initial psychological panic causes the price to dip, algorithmic protocols automatically trigger margin calls. Meaning, if a trader's account falls below a certain threshold, the exchange forcibly sells their assets to cover the loan.
A forced market sell.
A forced market sell, which hits that already hollowed out order book we talked about, driving the price down even further.
Which then triggers the next guy.
Exactly.
Yeah.
That sudden drop triggers the next trader's liquidation point, causing another forced sell. It is a mechanical death spiral. It is dominoes falling in real time, driven entirely by code, not human decision-making.
It really highlights the difference in environments. I think of traditional financial markets like a massive, heavy cargo ship.
Okay, I like that.
You have this incredible ballast at the bottom, central banks injecting liquidity, circuit breakers pausing the market, designated market makers.
Yeah.
It takes a massive, historic storm to actually rock that ship.
Right.
Crypto, on the other hand, is like a carbon fiber speedboat with absolutely zero ballast. It goes exponentially faster, which is why the wealth generation is so alluring.
Yeah.
But every single wave threatens to capsize it because there is no counterweight mechanism to keep it steady. If you oversteer during a wave, you flip.
That is an excellent way to visualize the mechanics. The lack of a ballast removes moral hazard. I mean, there are no bailouts for over-leveraged actors, which is why purists celebrate it.
Right, pure capitalism in a way.
Exactly. It forces ultimate accountability. But the consequence is absolute brutal volatility. And this brings us to a core thesis of the source material. This unsmooth, high-speed volatility acts as an incredibly efficient wealth transfer machine.
It transfers capital mechanically from the forced sellers to the patient capital.
Yes, the market naturally transfers wealth away from the impatient, the ones who drove the speedboat blindfolded, chased the megaphone stories, and panicked or got liquidated at the first sign of a wave.
And where does it go?
It transfers that wealth directly to the patient people, the investors who understand the lack of ballast and who intentionally place their limit buy orders at the bottom of those deep illiquid drops, just waiting for the leverage cascade to fill them.
Which sets up the hardest part of this entire deep dive.
Oh, definitely.
If the market mechanically transfers wealth from the impatient to the patient, how do you actually cultivate that required patience? Because let's be real, it's easy to say, be patient on a podcast or, well, in a deep dive.
Right.
But when you are watching your net worth bleed out on a Tuesday morning, saying be patient, feels like telling someone to stay calm while their house is literally on fire.
It really does. And it requires a fundamental rewiring of how you interact with your investments. It all comes down to the critical difference between chasing price and understanding underlying value.
Okay.
This is where discipline transitions from, a self-help buzzword into a literal survival mechanism.
Here's where it gets really interesting. The text explicitly calls out the biggest trap new investors fall into. They become entirely fixated on the numeric price.
Completely obsessed.
They stare at the 1-minute charts. They go on forums and ask, will this coin hit $100,000 by December? Or is this token going to explode next week?
And those questions are rooted purely in anxiety and an attempt to predict an unpredictable future. They're the questions of someone looking for a guarantee in a market that offers none.
Instead, the text argues we should be asking an entirely different question, which is, why does this asset actually command value in the broader economic system?
If we connect this to the bigger picture, asking why an asset has value is the first step in a vital chain reaction.
Walk us through that reaction.
Sure. When you stop looking at the 1-minute chart and start looking at, say, the network hash rate, the adoption curves, the mechanics of an immutable ledger, or the utility of decentralized smart contracts, when you actually educate yourself past the viral hype, you develop deep structural understanding.
Right.
And deep understanding creates conviction.
But wait, does conviction actually stop a 40% drop from hurting? I mean, even with a deep understanding of network adoption, watching a massive chunk of capital evaporate is going to make anyone sweat.
Of course.
So is conviction actually a shield? Or is it just a coping mechanism for surviving financial trauma?
It's not a shield against the mathematical reality of a drop, no. But it completely changes your timeline, which alters your reaction. Conviction dictates your behavior.
How so?
Think about the mechanics we just discussed. If you bought a token purely because an influencer said it would go up, a sudden 40% drop leaves you with nothing but panic, so you sell.
You just want out.
Exactly. But if your thesis is built on a 10-year horizon regarding the global adoption of decentralized settlement, a Tuesday morning liquidity cascade doesn't invalidate your thesis.
Oh, I see.
The price changed, but the fundamental reason you allocated capital remains entirely intact.
So you don't hit the panic button.
You don't hit the panic button.
Yeah.
In fact, macro speaking, investors with conviction actually become the stabilizing force of the market.
Wait, really? They stabilize it?
Yeah. When the impatient capital is panic selling into a hollow order book, the patient capital, the people with conviction, are the ones placing the buy orders. They literally absorb the sell pressure. They become the price floor.
That is a profound way to look at it. Investing in this space, then, isn't about having a crystal ball.
Not at all.
It's not about predicting exactly how government regulations will shape the landscape or knowing for certain which specific protocol will dominate in a decade.
Because investing has never been about seeking certainty. It is entirely about managing probability and managing risk.
Right.
It's about position sizing so that a leverage cascade doesn't wipe you out.
It really reframes the whole idea of what makes someone successful in decentralized finance. The people who survive and ultimately thrive, they aren't necessarily the smartest coders or the most connected insiders.
No, definitely not.
High intelligence doesn't magically prevent your amygdala from firing when you lose money.
High intelligence doesn't prevent panic at all. In many cases, it makes you overthink the panic.
That's so true. The survivors are simply the most disciplined. They are the most patient. They're the ones who recognize that operating the carbon fiber speedboat requires keeping a steady hand on the wheel when the water gets rough. They completely ignore the megaphone in the casino and focus on the mechanics of the game itself.
They recognize that the discipline required for crypto is essentially the discipline of the self. In a system where you act as your own central bank, you are entirely, uncompromisingly responsible for your own risk management.
So as we wrap up this deep dive, I want to bring this all back to you listening right now. We've covered a lot of ground today.
We really have.
We moved from the emotional trap of survivorship bias, where viral success stories manufacture a dangerous blind hope, into the structural mechanics of the market.
The unsmoothed reality.
Right. We explored how the lack of centralized market makers and the presence of algorithmic liquidations turn thin order books into brutal wealth transferring cascades.
From the impatient to the patient.
Exactly. And finally, we arrived at the realization that surviving those cascades requires deep education and the kind of timeline-altering conviction that turns patient capital into the market's ultimate price floor.
It demands a complete paradigm shift in how we think about personal financial responsibility. And to that point, I want to leave you with one final lingering thought to mull over today.
Go for it.
We've talked extensively about how decentralization removes the central bank from the equation, stripping away the guardrails and forcing us to rely on our own rigid discipline.
Right.
But consider this. If the original revolutionary promise of cryptocurrency was to free us from the strict rules and control of central authorities, does the absolute necessity for rigid, almost robotic personal discipline mean we haven't actually escaped control at all?
Wow.
Have we merely replaced the central bank with the unforgiving, relentless control of our own psychology?
That is a heavy question to sit with. Are we ever really free from control when managing capital is involved?
That's something to think about.
It really is. And that is exactly why we do these deep dives, to strip away the surface noise and challenge the foundational ideas behind these systems. Thank you so much for joining us on this intellectual journey today. We hope this gave you a sharper lens through which to view the forces acting on your portfolio. Stay curious, keep exploring the deeper why behind the market movements, and we will catch you on the next one.